Chapter 6, Master Budget and Responsibility Accounting. Within Chapter 6, we have multiple learning objectives. We are going to learn how to describe the master budget and explain its benefits. We will describe the advantages of budgets. We will prepare the operating budget and all of its supporting schedules. We will talk about using computer-based financial planning models for sensitivity analysis. We will be able to describe responsibility centers and responsibility accounting. We will understand and recognize that there are human aspects related to budgeting. And we will definitely come to appreciate the special challenges of budgeting in a multinational company. To begin with, if we wanted to define the word budget or budgeting in general, it is where we go and develop a quantitative expression of a proposed plan of action by management for a specified period of time. Now, in developing our budget, we're typically doing a budget for a predetermined length of time. We can do them for a month, we can do them for a quarter, we can do them for a year, we can do them for longer than a year. Generally speaking, most companies are developing what is called a rolling budget, and they are putting those together typically for a 1-year fiscal year for the company, and as we drop off or finish a month, we add on another month at the end. We use budgets to aid us in coordinating what needs to be done at our company in order to meet our goals and objectives. Therefore, we are going to get lots of individuals together at our company to help us gather all of the information and put together this budget or this plan with management. A budget generally includes both the plan's financial and non-financial aspects and serves as a blueprint for the company to follow in the upcoming period. Budgeting is a common accounting tool that companies use for implementing their strategy. You guys have possibly heard it before. Plan your work and work your plan. Therefore, if you do not make a plan, then you are likely not to succeed. Okay, so budgets need to be put together in order to plan our work. What gets measured gets taken care of and gets completed. So keep that in mind when you are going through the steps of putting the budget together, because what we're going to see is that we make this plan and we make this master budget, and then at the end of the period we are going to take our actual results for the period and compare those to our master static budget and a flexible budget and analyze our performance for the period. Okay, so budgets help managers communicate directions and goals to different departments of a company to help them coordinate the actions they must pursue to satisfy customers and succeed in the marketplace. All right, so we've got multiple components within our budget. Our sales budget or revenues budget is going to disclose how much we expect the sales people to sell during the period. It's going to disclose the pricing for the units that they're selling, as well as the quantity of the number of units that they are expected to sell during the period. We will then, at the end of the period, be able to analyze and compare what the plan said they were supposed to do versus what their actual performance was. Our production departments are going to be expected to produce a specific number of units, and they are going to be expected to do that at a certain cost. We'll be able to compare and analyze their performance at the end of the period. Same goes with our direct materials and our procurement department. They're going to be expected to buy the direct materials necessary in order to produce our products or services over the time frame. And at the end of the period, we can look to see, were we able to buy those direct materials components at prices that were expected, or did we have to pay more or less? We will also see that there's a lot of other underlying information that can be compared and analyzed. Okay, so we're going to use these to judge performance by measuring financial results against the planned objectives, activities, and timelines to learn about potential problems. We can learn about potential problems, but we can also learn about gains or improvements and efficiencies that have been brought to light by doing this same process. If we have multiple plants or divisions providing the same products or services, and one particular division seems to be outperforming the others, we may be able to see that they have come to understand and be more efficient in certain processes, use of materials, how they train their employees to perform their work, etc. And we can then take those gains and train the other plants and divisions to also perform at that greater level. Therefore, we will be able to motivate employees to achieve their goals. Okay, so it's kind of like giving a chorus or a choir some sheet music. All right, everybody's got to be able to sing their part, and they need to know what needs to be done and by when and for what cost, etc. All right, so giving them the directions and the expectations of management will motivate them to achieve their goals. To develop successful strategies, managers must consider questions such as the following. Our budgets are tied in to our strategic plan of our organization. When you all get into the BMGT 4400 class, many of the things that you have learned in this course will apply to the game that you all will be playing with and against your fellow students. What are our objectives? How do we create value or add value for our customers while distinguishing ourselves from our competitors? Are the markets for our products local, regional, national, or global? What trends affect our markets? What organizational and financial structures serve us best? What are risks and opportunities of alternative strategies? And what are our contingencies plans if our preferred plan fails? Okay, so many of these things need to be considered when we are putting our strategic plan together, and our strategic plan will fold into our budget. We have a budgeting cycle, and it typically starts well in advance of the period for which we are putting the budget together. So before the start of a fiscal year, managers at all levels take into account past performance, market feedback, anticipated future changes, and other indicators to initiate plans for the next period. Okay, so we're looking to constantly improve and be more efficient in our efforts. All right, we're going to take into account our past performance, look forward to see what type of improvements we can make as we proceed forward. We will take into consideration market feedback. If we're in the sales department, what types of things are our competitors doing? What do our customers have to say regarding the future, etc.? And all of these things need to be considered when we are putting our budget together. Senior managers are going to give subordinate managers a frame of reference against which they will compare actual results. Again, we're putting the plan together. It is how we will communicate with everyone within the company. And these subordinate managers are going to be in charge of making sure that the budget plan is strived for by those underlying departments. And then those individual managers will be evaluated on their distinct areas' performance. Managers and the management accountants will be the ones to investigate any deviations from the plan. And we will focus a lot on investigating these deviations in chapters 7 and 8 when we look into variance and variance analysis. The master budget is at the core of the budgeting process. Again, it expresses management's operating and financial plans for a specified period. Recall back from your Principles of Accounting courses that you learned to put together the income statement that shows our results of operations for the period. You all also learned how to put together the statement of retained earnings, also a balance sheet, and also the statement of cash flows. Our operations, the results thereof can be seen within the income statement, and that balance sheet shows us our financial position at the end of the period. We are going to include those two items in our budgeting process, and we will have a budgeted income statement and a budgeted balance sheet. We can also do a budgeted statement of cash flows, etc. Our operating decisions deal with how to best use the limited resources of our organization. You will be able to see here in a few moments that we have our budget process plotted out in a flow chart. And you're going to see that the operating budget entails multiple supporting budgets and schedules that support management's plan and shows our individual managers what is expected of them over time and how they are to utilize their resources. Our financial decisions deal with how to obtain the funds to acquire those resources. You will also see on our illustration that the financial budget contains our capital expenditures budget, a cash budget, which shows our sources and uses of cash during the period, spelled out distinctly. For example, when we expect payments to be received from our customers, when we will be paying our expected expenses and costs, as well as other items. And then, of course, I mentioned that we will put together a budgeted balance sheet, and that we can also go as far as to put together a budgeted statement of cash flows. Those are our financial budgets. The operating budgets are distinct and end with a budgeted income statement for the period that we are planning. Advantages of budgets are numerous. Again, we're putting this plan together to communicate with our employees what the plan is. Management is responsible for the budget. The management accountants help to facilitate putting this plan together and documenting all the information. But we should be using participatory budgeting, where we get information from all different groups and managers within the company. The better the information that we put into putting the budget together, the better our output, the more realistic, the more obtainable that the plan will be. So consider, effective communication is the key to success. And so we need to consider that when we're putting our budget together. Budgets promote the coordination and communication among the different subunits within the company. Everything follows in line behind the sales budget. Our sales budget, we need to make sure that we do the best job that we can in coming up with the number of units that we expect to sell and the price that we can sell those for, because everything is going to tie from then on through the process, because our production department needs to make sure that they can meet that demand. And the procurement people need to be able to purchase exactly what we need so that we do not run out of materials in the production department. Our HR department needs to make sure that we have got enough individuals on payroll or being hired in order to facilitate making or producing, manufacturing those items. Okay, so having this budget spelled out and showing these different schedules to the parties involved in making sure the plan comes to fruition is very, very important. It provides our framework for judging performance and facilitating learning. Again, we're constantly going to be striving for improvements. At the end of the period, we can compare those actual results to our budget, our plan, and see how we did for the period. And then use those to facilitate learning for going forward and making improvements for future periods. Again, it motivates our managers and other employees. Now, there are, of course, challenges in administering a budget. Top managers want lower level managers to participate in the budgeting process because they have more specialized knowledge of day-to-day management. However, the budgeting process is very time consuming. And as you all know, time equals money. So if it's very time consuming, then it's also very expensive. Upper level management has to have the tone at the top. And the tone at the top is completely crucial to the success of the budget and therefore the operations of the company. All right, so they set the tone. They need to fully embrace the budget. They don't need to be circumventing or working around things that are included in the budget because, again, they're setting the example for the employees beneath them. As I mentioned earlier, the time coverage of budgets is typically done for either a month, a quarter, or a year or longer. but the most frequently used budget period is for 1 year or 12 months. I mentioned earlier that businesses may also use a rolling budget. This budget is always available for a specified future period by continually adding a month, quarter, or year to the period that just ended. To facilitate the budget process, it is recommended that you use the 5-step decision-making process. This is mentioned in Chapter 1 of your text if you want to go back and take a look at that. Number 1, identify problems and uncertainties. Obtain information. This is a very important part. The better your information that goes into making the decisions, the better the results are going to be. Make predictions about the future. Make decisions by choosing among alternatives, and implement the decision, and then evaluate the performance, and then learn. We have multiple steps in our basic operating budget, and I am going to go through those briefly here, but I'm going to post you another very long and involved example for you of working through the concepts and the example in your Chapter 6 text. All right, so step 1, we would prepare the revenues budget. Step 2, we'll prepare the production budget. Step 3, we will prepare the direct materials usage budget and the direct materials purchases budget. We will then prepare the direct manufacturing labor budget. There are several other steps, but I want to point out here. Step 1 is very important. The revenues budget is also commonly referred to as our sales budget. How many units do we expect to sell and for what price? And based on that information, the rest of it goes in place to support making that happen. We have to produce so many units. We have to purchase so many items of direct materials in order to produce those units. We've got to have enough people on hand to manufacture and produce those units. Okay, so all of this is very important that we use good information from multiple people and put a very good plan or master budget together. Our 5th step would be to prepare the manufacturing overhead cost budget. You all will see that in this particular chapter, we are using our activity-based budgeting, which relies on activity-based costing, which you guys can go and refer to one of our earlier chapters that is available in the book. Chapter 5, Activity-Based Costing and Activity-Based Management, if you need a refresher. You should have learned those concepts in your cost accounting class. I am posting a video for you to watch. It is available on YouTube. It is one of the Wiley videos that I use in my Principles of Accounting 2 course. It shows activity-based costing as utilized by a company by the name of Precor. Make sure that you watch that video in addition to the video called Baby Cakes, which is also a Wiley video that I show in Principles 2. Make sure you watch both of those prior to doing your homework for Chapter 6 because I think they would be of help to you. Our 6th budget is our ending inventories budget. Think of the fact that we are going to have finished goods still in inventory at the end of the period. We would also have some direct materials still on hand in our raw materials inventory that would be available to start us on the very next day of the very next period. Okay, so we do not want to run out of direct materials or those raw materials for our manufacturing and production processes, because we don't want to have to push the big red button on the wall and stop the assembly line. Our finished goods inventory, we never want to run out of stock there, because we would have stock outs, and if we don't have inventory or stock for our customers to purchase, they will go elsewhere. Think of the fact too that where these ending inventories are going to show up, they will end up on the budgeted balance sheet for the period. Okay, so think about that. Again, I'm going to load one very long and involved video that goes through all of the example in Chapter 6, item by item of these steps. The 7th one is our cost of goods sold budget. Of course, our cost of goods sold budget is going to affect our budgeted income statement. And we will prepare our operating expense budget. Think of all the other operating expenses, not direct materials, not direct labor, not manufacturing overhead. Think of those other types of expenses that a company would incur that would need to be also covered on our budgeted income statement. And then lastly, we could put that budgeted income statement together. Again, these first 9 steps are directly related to the operating budget. Okay, so these 9 steps, know them in order, and they are all part of the operating budget. The financial budgets are separate. They are the capital expenditures budget, the cash budget, the budgeted balance sheet, and the statement of cash flows, the budgeted statement of cash flows. Okay, so notice how those all had to do with financing and the financial position of the company. All of these other ones that I've just showed you, 1 through 9, are distinctly related to operations. All right, I will go into the appendix section for our Chapter 6, so you do need to make sure that you go and cover the items that are listed there at the back of the chapter in the appendix in regards to those financial budgets. Okay, so based on the results in our budgeted operating budgets, we will then have information that needs to be plugged in. We will prepare a capital expenditures budget, which I will tell you is covered in your text more in detail in Chapter 21 of the text, and it is called Capital Budgeting and Cost Analysis. Okay, so if you wanted to go and look into Chapter 21 for a little more information regarding capital budgeting, please refer to Chapter 21. Step 2, preparing the cash budget. I will want you to be familiar with how to calculate cash receipts from customers based on how you expect them to pay your invoices or bills. I would also want you to be familiar with how to show when the company will be making its disbursements or payments to its suppliers for such things as direct materials. Other information that would show up on the cash budget will be when we expect to make those capital expenditures for things such as property, plant, and equipment. It will also show how we expect to pay the Internal Revenue Service for any income taxes. Also, when we will be paying our employees and other types of expenses. The budgeted balance sheet will show us what we would expect to see on our balance sheet if the operating budgets are all met. What will our assets be at the end of the period? What will our liabilities be at the end of the period? And what will our owner's equity or our equity balance be within the end of the period? And then lastly, we could also prepare a budgeted statement of cash flows showing all of this information. Okay, so here's the overview of the master budget that we basically just discussed. I will be pulling this item up in another video and working through all of these respective items as you can see them in your text. Okay, so again, I mentioned that we start with number 1 is our revenues budget or our sales budget. Based on that information, we will need to produce so many units, and we will put our production budget together. We would then need to purchase so many items of direct materials. All right, so our direct materials budget would need to be put together. We would also need to put together a budget related to the number of units that need to be produced and the labor that would be required to do so. So we would put together our direct manufacturing labor budget. And then we would do number 5, the manufacturing overhead budget. Again, we will be utilizing activity-based budgeting. So if you need to go back and look at that earlier chapter in the text, in addition to watching that pre-core video, that would be recommended. But we will put together our manufacturing overhead budget. And then based on those results, we can calculate our cost of goods sold budget. We're going to have so much in direct materials per unit, so much in direct labor per unit, and so much in manufacturing overhead per unit. And that can help us to come up with a cost of goods sold per unit that we can then show in this cost of goods sold budget. And of course, the cost of goods sold for the number of units that we will be selling are going to tie into this budgeted income statement farther down below at the end of our operating budget. So notice that all of these green ones are in the operating budget. We would need to also consider going forward research and development, costs and expenses that we're going to have for this upcoming budget time. Also, our marketing and advertising costs, our distribution costs, freight, and other items. All of those things need to be budgeted out in advance and also plugged in to our budgeted income statement. Therefore, this budgeted income statement will show for the period revenues, cost of goods sold, all operating expenses, etc., even including our budgeted interest expenses and our budgeted income taxes for this entire period of time, and our net income budgeted for the period. And then again, here's our financial budgets down here at the bottom. Notice distinctly it's only these 4. We would need to do a capital expenditures budget. Again, there's more information about that in chapter 21, but for the most part, you would just need to understand that, we may need to purchase property, plant, and equipment in order to make this happen. Okay, so if so, we would do that information within our capital expenditures budget. And if we do have to make capital outlays, those dollar amounts are going to be put into our cash budget. This cash budget is going to show our cash receipts for the period and our cash disbursements for the period. It will even show if we need to borrow any money, because many times we are going to set a floor, a minimum threshold, where we do not want to drop below that dollar amount in our available funds for the period. Okay, so we need to know in advance if we're going to need to borrow money, and putting together this cash budget for the period will help us to know in advance if we need to obtain some additional financing. This cash budget will even show if we need to pay interest and pay back financing obtained in a prior period. We will then be able to put together a budgeted balance sheet. Again, the budgeted balance sheet will show us, as of the end of the budget period, where will we stand from a financial position. It will show our assets, raw materials, inventory value. We will show finished goods inventory value. We will show what property, plant, and equipment at the end of the period we have, etc. Even our liabilities are going to show up here. So all of this is going to get tied in to this budgeted balance sheet. And we can also do a budgeted statement of cash flows.